It's always a pleasure. I always learn something. I take notes when I get to talk with Lance Roberts. Realinvestmentadvice.com. Realinvestmentadvice.com. Lance, first of all, appreciate you taking time. Great time to be chatting with you, obviously. I mean, who isn't talking about the market moves and the aftermath of the election? Uh, let's give it, and I'm really happy to get this sort of a week space, or since. I mean, we saw that initial huge move up. What perspective do you have on it right now?
Well, kind of it's wasn't real surprising. So going into the election, people were really getting very overhedged. There was a lot of buying of gold as a hedge
Mm-hmm.
for the election. There was a lot of buying of fixed income heading in the election. Portfolio managers were long volatility, but underweight equities going into the election. So the big concern was not really the outcome of the election. If the outcome of the election was either Republican or Democrat, that was okay. It was the risk of it being contested and
Mm-hmm.
dragging out until December, and there's a lot of rioting and protests and whatever. That was the concern of the market. So when the election went off very smoothly, and we had literally an immediate result, we knew by
Mm-hmm.
Wednesday that Donald Trump had won the presidency. All of a sudden that was a huge relief for the market. So everybody had to immediately kind of de-risk portfolios. So we saw gold sell off, we saw stocks rally sharply, and it was just kind of this reversal trade that happened. And markets moved up very quickly. We got overbought very, very sharply. We had just a very sharp increase. And so over the last few days, not surprisingly, the market's kind of given a lot of that back up. And now we're starting to kind of focus on, okay, we know what the presidency is now. We need to start focusing on, the market's earnings and those type of things into the end of the year. Um, but right now, the sloppiness in the market, you should expect that. It's
Yeah.
the week before, next week is Thanksgiving week. Traders are already kind of getting ready to leave for the holiday. We had a big run, markets got overbought, so you get a little bit of profit taking here. After Thanksgiving, we should have a rally that is the last week in November, probably first to second week of December. And we're going to run right into portfolio managers and mutual funds having to distribute their capital gains for the year. That's going to lead to some selling pressure, probably another little bit of a pullback in the market, which will then set the market up for that year end, last 5 days of the year portfolio window dressing by mutual fund managers, hedge funds, et cetera, for reporting purposes. You get that kind of Santa Claus rally into the end of the year as they window dress for reporting. So, market should be higher by the end of the year than it is right now, but it's going to be a sloppy trip getting there.
Well, obviously with the Trump victory, the assumption is it's factored into the market. You'll get tax reductions, may maintain the old tax
Right.
reductions. Maybe more importantly, regulatory reform, which will take a while to seep through, but people, of course, the market's anticipating that. So I've been wondering what's going to fuel the next major rise. If people have been betting on that, then what's going to be propelling past what you're saying? And you're going to be at the World Outlook Conference with us, and by then more stuff will be revealed. I'm looking forward to that. But I'm just that's one of the thoughts that's occurred to me, that people were ready to jump on board the Trump victory. They got the victory. That meant X, Y, and Z. Yep. And there seems to be no assumption that won't happen, with controlling the House and the Senate. So we'll get that. I'm just wondering, a little preview as you see going through the next year. Will it be earnings then? Will that get starting to be filter through to earnings, that kind of thing?
Well, that's the big question. So and we won't have an answer on this by the time the conference gets here. But this is going to be kind of the premise of the presentation I want to put together, is looking at where we are economically now and financially, and based on presumption of certain policies, what does that outlook look like? So as a good example, let's talk about tax cuts. So when they passed the Tax Cuts and Job Act in 2017, that was a huge, we went from basically 35% taxes to 21. So that was a huge boost to corporate profitability with that tax cut. Well, we're not, if so, that is likely going to get extended now. So it won't sunset in 26 like it was expected to, which means that tax rates will stay the same. Well, that's not going to really benefit corporations anymore. It's just going to keep things stable. So, knowing that, companies might be a little bit more inclined to spend and invest, knowing what their tax rate's going to be permanently now. They don't have to worry about it going back up. So what you've got to really look for now is, can he get corporate taxes cut from 21 to 15? So now if you do that, there's a 5% bump to earnings in theory. So, but this is where we start running into whether or not you can get policies passed. You still have to do a lot of these things through Congress. You do have a slim majority in both the House and the Senate, but you have what's known as what we call the Freedom Caucus that is in the House. And these are a group of Republicans that lean a bit more to the libertarian kind of spending and deficits and those type of things, want to get those back under control. So any type of bills that come through that may be, big spending bills or potentially increasing the deficit, you may lose 3 or 4 or 5 of these Freedom Caucus members, which may make it very difficult to get some of these bills passed. So, when we're looking forward and saying, okay, what's the next big driver for the market? Well, markets respond to 2 things. They respond to earnings. And if earnings and expectation for earnings are growing, then that's going to lead to higher asset prices. But earnings are a function of economic growth, which throws us into another problem, which is potentially one thing that Trump's talking about is doing things like the Department of Government Efficiency, where they want to cut $2 trillion off the deficit. They want to drastically reduce parts of government, like greatly reduce the Health and Human Services Department, greatly reduce the FDA, remove some of these departments, like the Department of Education, which, by the way, huge fan of. Department of Education has been an absolute dismal failure ever since 1980. It should go away, but that's a big reduction in government spending. That's going to impact economic growth, which will ultimately impact earnings. So, while some of these policies sound good, and they are good long term, you're not going to be able to implement these policies without some short-term pain. So I think we've got to be aware of that going into next year.
Let's stay on that for a moment. With the Department of Education is one, as you say, it's been outlined as big money, that it's also got to go through a process,
Right.
And that's, I want to remind people that, well, you got to get it through Congress, and then you got to get it through the Senate. So tell us a little bit about that process.
Yeah. So, and again, and we've not done this before where we've eliminated entire departments. I want to step back 1 second to talk about the Constitution for a moment, because under the Constitution, the government only has 2 jobs, and that is national security and infrastructure. That's their job. Department of Education, energy, FDA, all that stuff, that all belongs to the states. The states should be responsible for their own education, their own energy policies, all those type of things should all belong to the states. Whenever the government's got involved, it's been worse off than it was before. But now it's easy to establish these government agencies. Everybody likes more power and more control. It's hard to reverse these. And so again, like we said before, the process in some of these cases are going to have to go through Congress. There's going to have to be bills passed to do things. And also, too, government employees, Ronald Reagan once said that the hardest thing to do is that once there's a government program is to get rid of it. And it's very true, because government employees, you can't just fire them. If you're going to eliminate a department, you have to give them a job somewhere else in government. So reducing government employment is going to be, like, for instance, we go through government shutdowns about every couple of years here in the States ever since 2008. And we always lay off 900,000 non-essential workers. Well, if you're not essential, why are we paying you? Right, is the question. But we can only furlough them. We still have to pay them. Now, they don't get paid while they're furloughed, but when they come back to work, when we open the government back up, they get all their back pay plus, ongoing. So that's just a good example that it's very difficult. I mean, why can't we just fire the 900,000 if we're shutting down the government? Just fire them, and then we'll hire new people later. But you can't. That's part of the problem. So it's to your point. It's not, some of these things, they sound great, but getting them through Congress and getting them through Senate are going to be a little bit more challenging, because all it takes is 1 or 2 votes of somebody says, you know what, I really like the Department of Education, or you've got a senator as an example, that's funded by the largest union in the United States, which is the Student Teachers Union. And they go, hey, you know what? If you get rid of the Department of Education, you're out of a job. And all of a sudden, it's like, I'm against that. So, I don't think it's going to be nearly as easy as everybody thinks. And we're going to have to navigate markets depending on the results of these actions and what they come to fruition on. I think making a bet that Trump's going to come in and just transform. And again, look, I'm all for reforming government. It needs it. Needs it in a bad way. I'm all for cutting spending, so don't get me wrong. I'm just saying, when you try to go through such a massive reformation of government, it's going to be a very difficult process because there's too much power and too much money at play to go quietly into the night.
Yeah, and that's what was sort of the point of my opening comment was, getting from a slogan or a bumper sticker into
Yeah.
action, But the other side that isn't talked about as often, let's say, and of course it's early days, and people are angry about certain things. Some
Mhm.
people are angry Trump was elected, but I'm saying on the people who supported Trump are frustrated, so they want it done yesterday. They want that border closed right now, and it's difficult. But the other side and obstacle's got to be the corporate lobbying. I mean, there's so much money getting handed out to core. So yeah, I liked your example there that, maybe I would like to see reduction in government, but my election may be curtailed. Maybe I've been receiving funds from those corporations, or I'm feeling the pressure, or they're going to work against us. So it's just all these obstacles about such an entrenched approach to society. But the lobbying
Well,
is the one that I don't hear enough about, I don't think.
no, and look, it's that's really the biggest problem we have in government is the corporate lobbies. And about 5 years ago, we passed a spending bill. So if you live in Canada, don't really understand the workings of the United States, we used to have what's called a budget, and Congress would prepare a budget, the president would prepare a budget, and then they would kind of come together and they would negotiate the budget out. And then they would send the budget to the Senate, who would make some changes, and then the House and the Senate would reconcile the
Hmm.
budget, and then we would pass a budget, and then Congress, which is the ones that appropriate the spending, would appropriate the spending for the budget, and then that was the money you had to spend. Well, when Obama got elected, we decided that we were no longer going to do budgets anymore because it wasn't advantageous, right? Obama had big plans and he wanted to do things like the Affordable Care Act and all these other things. Well, doing a budget got in the way of passing these big reformation type bills
Interesting.
through the
Hmm.
House. So they just said, we're just going to do continuing resolution. So when we got to the budget time, they said, okay, we're just going to write a bill that says the spending's the same as it was last year plus 8%. And this is why the debts and the deficits in the US have just exploded since 2008. Because if you're compounding your spending at 8% a year, it's the old rule of 72, right? You're doubling your spending every 9 years. Well, here we are, basically, 18 years later, doubled
Yeah.
our spending twice. And this is why it just keeps going up. But corporations are, and one of those spending bills increase the amount of corporate donations by tenfold. So corporations can contribute massive amount of money to political campaigns through these super PACs and through these political action committees and fund these bills. And of course, when Congress is, they say, oh, we're going to vote on this bill, half the time they haven't read the bill. The bill's written by corporate lobby groups. They say, oh yeah, my corporation's the corn producers of America, and so we want a bill that subsidizes ethanol from corn production. So the lobby writes the bill, they send it to their congressman and says, hey, if you'll get this passed, we'll make sure you've got plenty of money for your next election. And when you talk to congressmen, they spend about 90% of their time lobbying for the next election
Yeah.
rather than doing their work. They're just constantly fundraising for the next election, and that's the problem. And so one thing that I liked is that President Trump recently put out 10 points to reform government. Number 10 was a great idea. It'll never pass, which was to provide term limits for members of Congress, both House
Hmm.
and Senate. So you can serve 2 terms and you're done, just like the president. And that would keep, if I can only serve 2 terms, I'm going to go do what's best for my constituents. not just jump on the gravy train of corporations. So you eliminate a lot of that. The problem is Congress has to vote for term limits. So I don't think they're going to vote themselves
Yeah.
out of office. So that'll probably never pass.
Let me fire a couple at. I don't want to run out of time without asking a couple things. One, you've written a great piece talking about, people are looking at the market and they're talking about the valuations of the market. And I just want you to elaborate a bit. You're saying, well, you don't time the market through evaluations. I mean, there's no record of that. So just explain that a bit, because that's a normal thing I'm hearing, that everything's so expensive. So ergo, I'm not going to. So can you go with that for a moment?
Sure, absolutely. We all get wrapped up in valuations, and we're like, oh, look at valuations. They're 35 times trailing earnings based on a 10-year window of earnings. That's the Cape-Shiller PE.
Mm-hmm.
And all valuations tell you is that you're overpaying for assets. And in the long term, over 10 years, that asset will likely return less money to you than it would otherwise if you could buy it cheaper. Think about it. If you go down to your local car dealership and a car normally sells for $30,000 and the guy says, oh, this is the best car ever, you need to buy it. And you go, okay, well, it's only $60,000. So you pay $60,000 for the car. Well, the next day you decide, well, you know what? I want to sell it. It's only worth 30. So you're immediately going to lose money. And that's the thing about valuations. But in the short term, if this is the car that everybody wants, then I can probably buy it for 60, and I can probably find some guy willing to pay me 62 for it tomorrow. And that's all about sentiment.
Mm-hmm.
So in the short term, over the course of a year, valuations are only a reflection of psychological greed or fear. So if valuations are rising, that just simply means that everybody wants to own stocks. And there's a very, very high correlation between consumer sentiment and valuations. And they track each other almost perfectly. So as consumer sentiment increases, everybody's getting more bullish. And a good example of this, the Conference Board does a whole consumer sentiment survey. They ask you about housing and cars. They also ask you about your 12-month outlook for stocks. The current 12-month outlook for stocks by consumers is the highest level on record ever.
Wow.
People are just can't get enough of the stock market. So naturally, if that's the case, valuations are going to be elevated in the short term because everybody wants to buy stocks. But in the long term, valuations are going to matter. But again, that just means that over the next, what valuations tell you in the long term is it tells you what your rate of return will be over a long period of time. And right now, valuations tell you that your return on your investment will be somewhere between 2 and 3% over the course of the next 10 to 15 years.
And it certainly, I'm hearing caution in that too, if you know what I mean, for what you've just said. But I'm hearing caution. I also want to come back to gold. And why? Because you were writing, oh God, it's probably about 3 weeks ago. You were saying, you know what? I don't need every cent out of the gold market. I think the sentiment's gotten a little too bullish, and so, you told your people just to take a break, let's get out. So a quick comment. I mean, I know everybody at realinvestmentadvice.com is happy about it, but obviously this is a business that says, what's next?
Right. So first of all, let me be clear, at Real Investment Advice and which is our website, realinvestmentadvice.com, and our firm is RA Advisors. We run lots of different portfolios for people. So we run 60-40 allocations, 80-20 allocations, 100% equity allocations, depending on your risk tolerance, dividend equity models. So we have a lot of different flavors. So sometimes people ask me, it's like, well, Lance, why do you own bonds? Because bonds suck right now. Well, because we have a 60-40 allocation model that we run for, people with less risk. So we have to own some bonds. We have a model called the all-weather model. And this is a model structured around the permanent portfolio strategy. And so about 9 to 10% of that portfolio was gold, precious metals. And we were looking at that model going, the return that gold has put in this year is really outsized relative to its historical normalcies. It's 4 standard deviations overbought on a monthly basis. It's extremely extended from long-term means. And in fact, on a monthly basis, there's only 3 points in history where gold was as overbought as it was just about a month ago. And at every one of those previous periods, that was the peak of gold for about a 3 to 4 year period. Now, I'm not saying that's the case now. I'm just saying that when gold gets to really massive extremes, you're going to have a price correction. So we reduced our, we didn't sell everything, right? But we reduced our exposure to equity and reallocated some of those funds elsewhere in the portfolio. Now, the question becomes, and then there were two reasons for that big run up in gold. One was the weakness in the dollar, and one was hedging for the election. There's a misunderstanding about why people buy gold. And remember, gold, and at the end of the day, gold really has no underlying fundamental value. It doesn't provide earnings. It doesn't have a dividend yield. It's a chunk of metal. And so its price is derived from psychology and from futures traders on the markets wanting to buy or sell it. So in the commodities market, if you've got a lot of people wanting to buy contracts on gold, that drives up the price. If they start selling those contracts, the price goes down. So central banks were buying a lot of gold to hedge the US dollar risk. And there's two ways so if I'm a central bank, I have to store my reserves somewhere, my reserve currencies. So I can do China, I can store it in Russia, I can store it in Ukraine, I can store it in France, Belgium, Germany. The reality is that people want to be in the US dollar. So two ways to get exposure to the dollar is I either buy U.S. Treasuries or gold. And we saw central banks loading up on gold to hedge against the dollar. And that was going into the election. Now that the election is over and favorable for the outcome of the U.S. dollar, we're now starting to see central banks starting to delever those gold positions and repurpose those reserves. So again, there was kind of a combination of factors that suggested you were going to get a pullback in gold prices. They're oversold now. I think we're going to get a decent bounce. Now the question becomes after this is, can it go back up and continue to make new highs? Or are we about to enter one of those longer term periods where it just kind of goes sideways and doesn't do anything for a while? And I don't have the answer for that.
Well, you've got an answer to a lot of things for us, and I appreciate that. This is just a flavor of what we are looking forward to at the World Outlook Conference. But in the meantime, you can go to realinvestmentadvice.com and you can click on and get the blog, Lance's current thoughts on everything, so you can monitor it all the way through at realinvestmentadvice.com. Lance, looking forward to seeing you in February. Great time. Thanks for taking the time today, though.
Absolutely. Love doing it. Thank you.